Where did the money go when a screen screams that trillions were wiped out overnight? If you've ever watched prices gap down and thought, did the economy just burn a pile of cash? You're not alone. Today I'll show you A, how $1 trillion loss is usually a pricing change, not money disappearing. B, how leverage in the derivative stack can turn a normal sell-off into a cascade. And C, why the biggest clue is often something most people miss, what happens to liquidity when everyone tries to exit the same door at once. Let's set expectations early. This is educational content, not financial advice, and I'm not telling you what to buy or sell. The goal is to make the headline make sense so you can respond with a process instead of adrenaline. The key idea is simple but unintuitive. Markets are not a bank account where dollars sit neatly until they get deleted. Markets are an ongoing auction. When the last trade prints at a lower price, every similar asset gets revalued at that lower clearing level. That's why market cap can fall by trillions even if only a small fraction of shares traded that day. Picture an example. A company has 1 billion shares. If the marginal trade moves the price down by $10, the displayed market cap is suddenly $10 billion lower, even though nowhere near $10 billion in cash had to physically move at that moment. So when you ask where did the money go? The first answer is, it didn't go anywhere in one piece. The headline number is an accounting snapshot. Yesterday's price minus today's price, multiplied across all units. It's mark to market. Some investors sold to someone else at lower prices. The seller realized a loss relative to their purchase price, and the buyer now holds the asset at a new cost basis. The missing money is the difference between two valuations, not necessarily a pile of cash that existed. That doesn't mean the pain isn't real. People do realize losses, portfolios do shrink, and spending behavior can change, but it does mean the story is more about repricing and transfer than evaporation. Next, the accelerant, leverage. Big fast drops often come from forced decisions, not thoughtful ones. In many markets, the futures market sets a reference price that ripples outward. Futures contracts are standardized agreements tied to an underlying asset, and they're typically traded on margin. Margin is powerful because it lets a trader control a large notional amount with a smaller deposit. But the trade-off is brutal. If the position moves against you, you can get a margin call and be forced to close. That forced closing becomes immediate selling pressure, which can push prices down further, which triggers more forced closing. The mechanism is boring, not mystical. Collateral requirements rise, risk systems cut exposure, and leveraged players become involuntary sellers. If you've ever wondered why charts sometimes look like an elevator rather than stairs, this is a big reason. Here's a step-by-step way to understand the cascade without getting lost in jargon. 1. A catalyst hits. Maybe a surprise data release, a shift in rate expectations, or a funding squeeze. 2. Initial selling pushes the price through key levels. 3. Stop-loss orders and systematic strategies react, adding more sell orders. 4. Volatility jumps, so clearing firms and brokers raise margin requirements. 5. Leveraged accounts that can't post more collateral are liquidated. 6. Dealers and market makers widen spreads because liquidity is getting risky. That last step matters. When spreads widen, the cost of exiting rises, and the selling pressure can become self-reinforcing. None of this requires a secret meeting. It's the predictable behavior of risk controls interacting with thin liquidity. Now let's talk about paper versus physical, because it's a common source of confusion. In commodities and precious metals especially, you can have multiple layers of pricing, spot references, futures prices, ETFs that hold inventory or use intermediaries, and the physical retail market where fabrication, shipping, and availability matter. In stressed periods, those layers can diverge. A falling spot quote doesn't automatically mean you can buy unlimited physical supply at that price, because the retail premium includes minting capacity, dealer inventory, delivery times, and hedging costs. Conversely, a rising premium doesn't automatically prove the price is fake. It can simply reflect bottlenecks and risk. Think of it like airline tickets. The average fare statistic can drop, while the specific route you need spikes because seats are scarce. Same product category, different access and constraints. So, where did the money go during a sharp drawdown? A more accurate framing is, who absorbed the selling and under what conditions? Some of it goes to cash-like instruments temporarily because investors reduce risk, some flows into short-term government bills, some rotates into defensive equities, sometimes it moves into other currencies, and some of it is simply transferred. The seller who panicked sold to a buyer who demanded a discount. This is why big down days often coincide with huge trading volume. Ownership is changing hands. Another underappreciated point is hedging. When large portfolios hedge with options, dealers who sold those options may dynamically hedge by selling the underlying as it falls, adding to pressure. Again, it's a mechanical feedback loop. The money doesn't vanish, the clearing price changes, and risk management pushes trades through a narrow liquidity pipe. Macro conditions decide whether these episodes stay contained or spill over. 2 to 4 big drivers to watch: interest rates and especially real yields, dollar funding conditions, inflation expectations, and fiscal credibility. If rates are rising and growth expectations are falling, many assets can drop together because the discount rate is higher and cash flows are questioned. If funding markets are stressed, players sell what they can, not what they want, often the most liquid holdings first. That's why you sometimes see good assets sold off alongside bad ones. In those moments, it can look like the whole market is broken, when it's really a balance sheet constraint problem. People are meeting collateral calls and reducing gross exposure. Let's make this practical with a clean framework you can use the next time. Where did the money go? Starts trending. First, identify what you own: unlevered shares, leveraged ETFs, options, futures, or physical. Each behaves differently under volatility and liquidity stress. Second, map your forced sell risks: margin, expiration dates, callable loans, or concentrated positions. Third, separate price from access. Can you transact near the quoted price, or are spreads and premiums exploding? Fourth, pre-commit rules for decision-making. What would cause you to reduce risk, add risk, or do nothing, based on your time horizon? Fifth, plan for the operational side: settlement times, taxes, and the possibility that I'll just get back in can be harder in fast markets than people assume. Common mistakes I see from newer investors: using tight stop losses in products that gap, confusing market cap losses with cash destruction, taking on leverage without understanding margin calls, assuming ETFs and physical assets will always track perfectly, and watching only price while ignoring liquidity. Volatility itself is a risk, because it can force bad timing. Counterparty risk matters too. If you're using derivatives, your experience depends on brokers, clearing, and rules around liquidation. Regulation and exchange interventions can change behavior during stress. And timing risk is real. Even if you're right about long-term fundamentals, you can be wrong about the path. If you want a short what to track list for the next episode, watch 1. Funding stress indicators and short-term rate volatility. 2. Futures open interest and signs of forced deleveraging. 3. Bid-ask spreads and market depth in your key assets. 4. ETF flows versus the underlying market's ability to absorb them. And 5. Physical premiums and delivery times if you care about physical exposure. You're not trying to predict every tick. You're trying to understand whether the market is in an orderly auction or a liquidity event. Mini recap. Before we wrap, a $1 trillion headline is usually mark-to-market, repricing, not a vault being emptied. Fast drops are often driven by leverage, margin calls, and systematic selling interacting with thin liquidity. And where did the money go? Is best answered by following who was forced to sell, who had patient capital to buy, and what the macro backdrop is doing to discount rates and funding. If you found this breakdown useful, like and subscribe. It helps the channel reach more beginners who are trying to make sense of scary market days. One question for you: when you see a violent sell-off, what's the first metric you check? Volume, spreads, funding rates, or something else? Remember, markets are risky, leverage can magnify losses, and no framework removes uncertainty. This is educational, not financial advice.